evening. The topic of my presentation is money markets. Now, what is basically money market? Money market basically refers to a section of the financial markets where financial instruments with high liquidity and short-term maturities are traded. Money market has become a component in the financial market sector for buying and selling of securities which basically have short-term maturities. So basically it's a high liquid market with maturity periods of less than a year. It plays an important and significant role in the economy as it serves as a market for indulging in transactions for a short period, and therefore it has to offer the facility of adjusting liquidity for the businesses, corporations, government, banks and individuals as well. Now, to study more in depth about the role of the money market, now it facilitates a parking place to employ short-term surplus funds. A lot of people, a lot of banks, a lot of corporate businesses, corporations, financial institutions have a lot of surplus funds that they can invest in money market to get a certain amount of return for very low risk and keep money liquidated. It aids room for overcoming short-term deficits. It enables the central bank to influence and regulate liquidity in the economy through market intervention, and it helps reasonable access to all users of short-term funds to meet their requirements quickly, adequately, and at reasonable cost. Next, we move on to what are the functions of money market. Now, one of the main functions is to maintain money-related equilibrium, that is, maintaining a balance between the supply and the demand for short-term money. It also promotes the growth and development of the economy. This is done by making money available for different units of the economy, for example, small-scale industries and agriculture, etc. It also provides assistance to industry and trade, and it does this by providing sufficient funds to trade in as well as to invest in the industry. It helps in the implementation of monetary policies. It offers non-inflationary finance sources to the government, which is basically achieved by generally issuing treasury bills or for the purpose of raising short-term loans for the government. Next, we move on to what is the importance of money market. First, it caters to the short-term financial needs of the economy. Here, when we refer to the economy, we take in consideration all the participants in said economy, that is banks, financial institutions, non-financial institutions, individuals, business corporations, as well as the government. Then it helps in the effective implementation of RBI's monetary policy, as well as overcoming short-term deficits. It helps in maintaining an effective balance between the supply and demand of the funds, as we've discussed in its function of maintaining equilibrium. It helps meet the need for short-term fund requirements of the government, and it also helps maintaining liquidity in the economy. Now, one other thing to consider is what factors affect money market. Now, the money market basically determines the interest rate that prevails in the economy. Now, this is affected by the demand for money. Now, what is the demand for money? Demand for money is affected by the income, and the income is determined by the goods market. Now, the goods market is dependent on the planned investment, which ultimately depends on the interest rate, and therefore this is a whole cycle that basically affects the working of the money market. Investments in this market are basically characterized by low rate and a fairly low interest rate, as well as a fairly low risk rate. Now, to consider the money market as a whole separate financial market, we also need to understand what are the different segments of the money market and what all can an investor and different institutions deal in. So first we have call money market, a treasury bill market, commercial bill market, a certificate of deposit and commercial papers market. Now, a call money market basically is one of the most important segments of the money market. It deals with call loans or call money granted for 1 day. This call or notice money is a short-term fund repayable on demand with a maturity period varying between 1 day to 14 days. Now, a majority of the participants in these markets are bank, and therefore is also called the interbank call money market. It primarily serves the purpose of balancing the short-term liquidity position of the banks. This means that it's mostly required by the banks to meet their CRR requirements that is expected of them. Next, we move on to the Treasury bill market. Now, a Treasury bill or a T-bill is an instrument of short-term borrowing by the government of India. It is a kind of finance bill or a promissory note that is issued by the RBI on behalf of the government. It raises short-term funds to bridge basically any seasonal or temporary gaps between the receipts and the expenditures of the government. Now, the main features of a treasury bill can be discussed as that they are negotiable securities. They are issued at discount and redeemed at par on maturity. For example, when a government issues a treasury bill, let's say that the face value of the treasury bill is rupees 100. Now, when an investor or a public individual purchases that bill, he or she will do so at a rate of 95 or 90 rupees, right? And when the treasury bills are redeemed after a particular amount of days that it is issued for, it will be redeemed at par, which means that the full rupees 100 will be given. And so the difference between the purchase rate and the redeem rate is the return that the investor gets from the side of the government. Third feature is that it has high liquidity on account of short tenure and interbank repos. The treasury bills are of different time periods that last up to a year, starting from 91 days, 182 days, and then finally a 364 days treasury bill. One of the most important features as to why treasury bills are consistent is that it assures yield and has a low transaction cost. Next, we move on to the commercial bill market. A commercial bill is a short-term, negotiable and self-liquidating instrument with low risk, right? So it is also called bills of exchange, which is an unconditional order signed by the maker directing to pay a certain amount of money to the bearer of the instrument. For example, let us take an example of two people conducting a business transaction. There's a seller who's selling goods to a buyer. Now, the buyer, if indulging in a credit transaction, will ask for a bill of exchange. Now the seller drafts this bill of exchange stating that this particular person has to pay the seller this particular amount of money after this particular period of time, which is usually 3 months. And once the bearer of the instrument signs, it becomes from a trade bill, it becomes a commercial bill when cashed into a bank. And these bills generally gain maturity over a period of 3 months. Next, we talk about certificate of deposit market. A certificate of deposit is a marketable, negotiable receipt of funds deposited in a bank for a fixed period at a specific rate of interest. Now, the certificate of deposits issued by banks should have a maturity period of 7 days to 1 year generally, but financial institutions that issue a certificate of deposit can issue it up to 1 to 3 years. Next, we move on to commercial paper market. Now, a commercial paper is a short-term, unsecured negotiable instrument that consists basically is a kind of a promissory note with a fixed maturity. Now, commercial papers are generally issued by companies as a means of raising short-term debt. It is usually issued on discount to face value basis, but it can also be issued in an interest-bearing form. So basically, these were the different segments of a money market. Now, in conclusion, what we've basically covered is that money market is a high liquid short-term funds market, and it plays the role of maintaining an equilibrium in the economy, assisting short-term fund requirements for both the investors and the government, and helping in economic growth and industry development. We also consider different segments, which were basically call money market, treasury bill market, a commercial paper market, a certificate of deposit market, and a bills of exchange market. Thank you.